The IRS already knows. That is not a warning. That is not a scare tactic. That is the operational reality of 2026. Right now, at this very moment, an automated government system is cross-referencing your county deed records, your mortgage lender reports, your home equity loan statements, your Airbnb payment history, and your estate filings against every tax return you have ever filed. The system does not sleep. It does not take weekends off. It processes millions of records simultaneously. And the group it is flagging more than any other group in the country right now is senior homeowners with substantial home equity. If you are over 60 and you own a home, there is a very real possibility this system has already identified a discrepancy on your return. Not because you did anything dishonest, not because you intended to break any rules, but because the IRS spent years without the tools to catch the kinds of reporting gaps that affect homeowners. And that era ended. The system is built. It is running. And the window to get ahead of it closes on May 19th. Stay with every word of what follows, because what you are about to learn in the next few minutes could save you thousands of dollars and protect the home you have spent a lifetime building. What changed and why it matters now? For decades, the IRS operated with a limited budget, outdated computer systems, and nowhere near enough staff to verify whether what was on your tax return matched reality. Audit rates dropped to historic lows. Compliance gaps went undetected for years. Millions of Americans, many of them seniors, were making completely normal financial decisions involving their homes without anyone ever explaining that those decisions carried specific tax reporting requirements. They added a child to the deed to avoid probate. They took out a home equity line of credit to cover medical expenses. They rented a spare bedroom through Airbnb to supplement a fixed income. They inherited property from a spouse or a parent and simply continued living in it. Every single one of those actions can trigger a specific IRS reporting obligation. And for years, almost nobody was caught because the IRS did not have the tools to check. That changed in 2022 and 2023. Congress authorized approximately $80 billion in new IRS funding through the Inflation Reduction Act. A significant portion of that money went directly into enforcement technology. The IRS used it to build automated data matching systems that pull information from sources that were never connected before. County property records, mortgage lenders, home equity loan servicers, title companies, short-term rental platforms, estate and probate court filings. All of that data now feeds into machine learning systems that compare it against every tax return associated with the property owners involved. The system is not looking for suspicious behavior. It is looking for mathematical discrepancies. A deed transfer with no Form 709. A 1099-K from Airbnb with no Schedule E on your return. A home equity loan with a claimed interest deduction that does not align with the loan's stated purpose. An inherited property sale with no documented basis. When the system finds a discrepancy, it generates a notice automatically. By the time that notice arrives in your mailbox, the analysis is already complete. The IRS is not asking whether there is a problem. They are informing you they have already identified one. The 4 triggers flagging senior homeowners. Right now. There are 4 specific transactions that are generating automatic flags on senior homeowner returns right now. There is a strong probability that at least one of them applies to you or someone close to you. Trigger 1, home equity loans used for non-home purposes. This has become extremely common among seniors over the last several years. Inflation has driven up the cost of groceries, utilities, prescription medications, and everyday living expenses. Millions of older Americans have turned to their home equity as a financial resource. Maybe you took out a HELOC to pay off credit card debt. Maybe you used it to help a grandchild with college tuition. Maybe you needed it for a medical procedure that insurance did not fully cover. Those are completely understandable decisions. But here is what your lender almost certainly did not tell you. Under the Tax Cuts and Jobs Act of 2017, which remains in effect today, home equity loan interest is only tax deductible if the loan proceeds were used to buy, build, or substantially improve the home that secures the loan. IRS Publication 936 is very clear on this point. If you use the money for anything else, medical bills, debt consolidation, tuition, or living expenses, the interest is not deductible. Period. If you or your tax preparer claimed that interest as a deduction on Schedule A of your return, you now have an incorrect deduction on file that the IRS can identify through their lender data matching systems. The penalty structure includes the additional tax owed on the incorrectly deducted amount, plus interest calculated from the original due date of the return, plus a potential accuracy-related penalty of 20% of the underpayment. For a senior on a fixed income, that combination of back taxes, interest, and penalties can easily reach several $1,000s. Trigger 2. Adding a family member to your home's deed. Millions of seniors have done this with the best of intentions. You add your adult son or daughter to the deed, so the house transfers to them automatically when you pass away without going through probate. Or someone advised it would protect the home from Medicaid recovery. Or you simply wanted to make things easier for your family. Those motivations make complete sense from a family planning perspective. But from a tax perspective, adding someone to your deed is not a simple administrative change. It is a transfer of a partial interest in real estate, and the IRS treats that transfer as a taxable gift. When the value of that transferred interest exceeds the annual gift tax exclusion, which is $18,000 per recipient for 2026, you are required to file IRS Form 709, the United States Gift and Generation Skipping Transfer Tax Return for the year in which the transfer occurred. If your home is worth $400,000 and you added your child as a 50% owner, you transferred $200,000 in value. Not filing Form 709 when required is a reporting violation that carries its own penalty structure. There is also a second consequence that most people never consider. When you give property as a gift during your lifetime, the recipient receives your original cost basis, not the current market value. That is called carryover basis. But when someone inherits property at death, they receive a stepped-up basis equal to the fair market value at the date of death. The difference between those two outcomes can be enormous. If you purchased your home for $80,000 30 years ago, and it is now worth $400,000, your child inheriting it at your death would receive a stepped-up basis of $400,000 and could sell it with little or no capital gains tax. But if you gifted them a 50% interest while you were alive, their basis on that half is only $40,000. The capital gains exposure on that difference can reach tens of thousands of dollars in unnecessary tax liability, created by a decision made with good intentions but without complete information. The IRS is now identifying these unreported gift transfers by cross-referencing county deed records against Form 709 filing records. If a deed change appears in county records but no corresponding form was filed, the system flags it automatically. Trigger 3. Rental income from your primary residence. This one has expanded significantly because of how easy platforms like Airbnb and Vrbo have made it to rent out a room or your entire home while you travel. For seniors on fixed incomes, a few $100s a month from renting a spare room can be genuinely meaningful. The difference between covering property taxes comfortably or falling behind. But the moment you begin receiving rental income from any portion of your primary residence, you have changed the tax character of that portion from personal use to income-producing use. The rental income must be reported on Schedule E of your tax return. You must properly allocate expenses between personal use and rental use. And you must account for depreciation on the rental portion, which affects your cost basis and therefore your taxable gain if you ever sell. Under current enforcement rules, platforms like Airbnb and Vrbo are required to issue Form 1099-K to any user who receives more than $600 in gross payments during the tax year. That form is sent simultaneously to you and to the IRS. If you received rental income through one of these platforms and did not report it on your return, the IRS does not need to audit you to find out. They already have the data. Their matching system compares the 1099-K against your filed return. When the income does not appear on Schedule E, the system generates a notice. The most common notice is the CP2000, an automated underreporter notice. It is not technically an audit, but it carries similar weight because it is a computer-generated assessment that presumes you owe the tax on the unreported income plus interest plus a potential accuracy penalty. If you do not respond within 60 days, the proposed assessment becomes final and the IRS can begin collection actions, including filing a federal tax lien against your property. Trigger 4. Inherited property with no documented basis. This one is especially difficult because it typically affects people who were navigating one of the most painful experiences of their lives when the mistake was made. When you inherit property, whether it is your deceased spouse's share of the family home or a vacation property from a parent, the tax code provides one of its most valuable benefits, the stepped-up basis. Your cost basis in the inherited property is the fair market value at the date of death, not what the original owner paid decades earlier. This can eliminate or dramatically reduce capital gains tax when you eventually sell, but the stepped-up basis only works if it is documented. If the estate did not obtain a qualified appraisal at or near the date of death, if no Form 706 was filed for estates that met the filing threshold, if no records were created establishing the fair market value at the time of inheritance, then you are holding property with an undocumented basis. And under the IRS's current enforcement posture, an undocumented basis is treated as a zero basis until proven otherwise. If you sell an inherited property for $300,000 and cannot document what your stepped-up basis should have been, the IRS can assess capital gains tax as if your basis were zero. On $300,000 of gain, that could mean a tax bill of $45,000 to $70,000 or more, depending on your income and filing status. The IRS is actively identifying inherited properties through estate filing records and probate court data and matching them against subsequent sale records to determine whether proper basis documentation exists. 5 steps to take. Before May 19th, the window to get ahead of this is open right now. Here is exactly what you need to do. Step 1. Gather every document related to your home going back to 2022. Your original purchase documents, the closing disclosure from when you bought the home, records of every major improvement you have made, a new roof, a kitchen renovation, a bathroom addition, new windows, a new HVAC system. Under IRS Publication 523, the cost of permanent improvements increases your basis, which reduces your taxable gain when you sell. Many seniors have invested tens of thousands improving their homes over decades, but never maintained organized records. That missing documentation could be costing real money. Also locate any home equity loan or HELOC statements, original loan agreements, annual statements, records showing what the funds were used for, and any deed or title documents showing ownership changes. Step 2. Compare your last 3 filed tax returns against those documents. You do not need to be a tax expert. You are simply looking for misalignments. Did you take out a HELOC but there is no mention of it on your return? Did you change your deed but there is no Form 709 in your records? Did you receive rental income but there is no Schedule E? Did you sell or transfer property but there is no Form 8949 or Schedule D? You are not solving the problem yet. You are determining whether one exists. Step 3. Bring what you found to a qualified tax professional, specifically a certified public accountant or an enrolled agent with experience in real estate taxation and IRS penalty procedures. You can find an enrolled agent through the National Association of Enrolled Agents. You can find a CPA through the American Institute of CPAs. When you call, ask one specific question. Do you have experience with IRS penalty abatement for real estate-related compliance issues? If the answer is yes, you have found the right person. Step 4. Create an account at irs.gov and access your tax transcript. This is one of the most powerful and most underused tools available to any taxpayer, and it is completely free. Your transcript shows every return processed under your Social Security number, every notice or assessment issued, and every piece of third-party data reported to the IRS under your account. Every 1099, every W-2, every 1099-K from rental platforms. Setting up the account takes approximately 15 minutes through the ID.me verification process. Once you are in, you can see exactly what the IRS sees. If there are pending notices you are unaware of, they will be visible there. This is how you stop guessing and start knowing exactly where you stand. Step 5. If you have already received IRS notices and have not responded, address them immediately. Every notice has a response deadline. If it has not passed, respond before it does. If it has passed, contact a tax professional right away because an unanswered notice does not disappear. It escalates. An unanswered CP2000 becomes a statutory notice of deficiency. That becomes a final assessment. A final assessment becomes a collection action. A collection action can become a federal tax lien against your home. That progression unfolds over months, but every step makes the situation more difficult and more expensive to resolve. One more warning. The scammers. Every time a high-profile tax issue affects seniors, fraudulent activity increases within days. Individuals claiming to be IRS agents demanding immediate payment. Emails with official-looking logos asking you to click a link. Companies promising to make your problems disappear for a large upfront fee. The real IRS initiates contact exclusively through United States Postal Service mail. They do not call demanding immediate payment. They do not threaten arrest over the phone. They do not accept gift cards, wire transfers, or cryptocurrency. They do not send emails requesting personal information. If anyone contacts you and creates urgency around immediate payment by any of these methods, it is fraudulent. Hang up, delete the message, and report it to the Treasury Inspector General at 1-800-366-4484. The bottom line. The IRS has more data, more technology, and more enforcement capacity in 2026 than at any point in its history. Senior homeowners are being flagged at higher rates than any other demographic for unreported property transactions. The window to come forward voluntarily and take advantage of penalty relief provisions is open right now, but it narrows considerably after May 19th. The steps are clear. Gather your documents, compare them to your returns, consult a qualified professional, check your IRS transcript, respond to any outstanding notices immediately. You did not create this situation intentionally. Most people affected made perfectly reasonable decisions about their homes without anyone ever explaining the tax consequences. But understanding that does not change what needs to happen next. What changes your outcome is action. Informed, timely, specific action taken before the deadline passes. Share this with anyone over 60 who owns a home. That one share could save someone thousands of dollars and protect the home they spent a lifetime building. Subscribe to Benefits Blueprint USA because these updates continue throughout 2026, and every one of them is designed to keep you one step ahead. Title options. Option 1, most recommended, IRS is watching senior homeowners in 2026. 4 triggers that flag your return. Automatically. Option 2, urgent. If you own a home and you are over 60, the IRS already has your data option. 3. Senior homeowners are being flagged by the IRS right now. What you must do before May 19th. SEO description. The IRS is using new automated technology in 2026 to cross-reference county deed records, mortgage lender reports, Airbnb payments, and estate filings against every tax return on file. And senior homeowners are being flagged more than any other group. In this video, Benefits Blueprint USA breaks down the 4 specific transactions triggering automatic IRS flags on senior homeowner returns, and the 5 steps you need to take before May 19th to protect yourself. In this video, you will learn why the IRS now has access to your deed records, HELOC statements, and rental income data. The home equity loan deduction mistake millions of seniors made without knowing it. Why adding a family member to your deed may have triggered a gift tax filing requirement. How Airbnb and VRBO are reporting your rental income directly to the IRS. The inherited property documentation gap that can result in a $70,000 tax bill. 5 specific steps to take right now before the May 19th deadline. This is not speculation. The The IRS enforcement system is operational and running right now. The window to get ahead of it is open, but it is closing. Watch now and take action before it is too late. Subscribe to Benefits Blueprint USA for weekly updates on tax rules, benefits, and financial protections that directly affect seniors and homeowners. Hit the notification bell so you never miss a critical deadline update.